Hello guys and welcome again to my channel. So my mission is still to complete the financial management series that I am making. And one of those topics in the basic financial management topics is the cost of capital. So as you can see there, this is my simplified definition in layman's point of view. Cost of capital is actually the cost of using others' funds. Okay? Actually, there is also a cost of using your own funds, which we will talk about later on. Okay? So let's talk about first cost of capital as the cost of using others' funds. So companies are in need of funds, right? So mostly the companies that are still starting is needing funds in order to operate, right? And if there are mature corporations already, sometimes it needs funds in order to venture or branch out, for example, or expand. So basically, corporations, my point is corporations, organizations, and businesses are in constant need of funds, or sometimes it needs others' funds. Okay? So if you're going to use others' funds, of course, you have to pay for the cost of capital. So why is it here in the financial management? Our point of view here, I said in the past episodes, our point of view should be of the financial manager. One of the jobs of a financial manager or finance manager is to look for sources of funds with the lowest cost of capital. Okay? So, let's have an example immediately so that you can relate. For example, there are two major sources of funds that you could avail. You could have debt, you could have equity. Or you can talk about this as selling of shares to shareholders. Both of these activities, you'll be able to get funds. Alright? But it's much better if ever you're gonna go to the source where there is the lowest cost of capital. So, if you are going to have this first option, the cost of capital here is the interest. Like, interest on long-term loans. So that's cost of capital. So it's very much relatable. Alright? Again, let me repeat, the cost of capital is just like the cost of using others' funds, like interest when it comes to debt. Okay? Now, if you're going to have this second source of fund, like when you sell shares to shareholders, of course you're going to get some money, but you'll have to pay dividends. Okay? So those are cost of capital. Alright? Now, let's go first here on the debt. Later on, we'll talk about the equity. So, when we talk about debt, again, we have interest. And normally, the cost of capital is expressed in terms of percentage. For example, you have loaned. Okay. Let me erase this first. We're going to talk about the equity later on. You have loaned 5 million pesos from a bank. And then, you are going to pay 10% interest. Is this the cost of capital? Normally, it's yes. That is the cost of capital. It's in percentage format and it is interest. Okay? Now, however, there is a twist here. Because if we're going to talk about what is really the cost of capital, it's not actually this 10% because you still have to get the after-tax rate of this 10%. Like for example, if the tax is 30% in a particular country, then that means the after-tax is only 70%. So that means 10% times 70%, that is about 7% only. That is the cost of capital. First question, why should it be after tax? Okay, so that's the first question. Second question, how important is the cost of capital for businesses, for organizations, and Yeah, for businesses and organizations. So let's have the first question. Why does it need to be after tax? So interest actually is tax deductible. So that means when we talk about income tax, for example, you'll have revenues and you'll have expenses. Part of these expenses is the interest expense. For example, we have 10 million and then the expenses is 8.5 million. But this 8.5 million still is exclusive, for example, of interest. So this is not yet including interest. So let's compute the interest. So that is how much? 5 million times 10%, that's 500,000. So that is interest expense. So you'll have 10 million times minus 8.5 million and 500,000. You will get 1 million. The net income before taxes. Okay? And then you get the tax. So the tax is about 30%, as I've said earlier. So the 30% of 1 million is 300,000, and you'll have 700,000. This is the net income after taxes. As you can see here, the interest expense is still before tax. So why does it need to be after tax? That is the first question that we need to answer. Of course, this 1 million has been taxed. It's 700,000 only will go to the company or to the owners. Okay? The 30% will go to the government. So if we're not going to summarize it like that, that means 30% of the revenues will go to the government. How about the expenses, including the interest expenses? That burden, 30% of that will also go to the government. You understand? So if that is the case, like if the government will have 10 million times 30%, that's 3 million. 9 million times 30%, it's about 2.7 million. So 3 million minus 2.7 million, they're gonna have a net of 300,000, which is here. Which means you should not consider 100% interest as your burden as a company. Okay? That is why you have to after tax it, because the 10% is not really your full burden. I'm so sorry, it's raining outside. That is not really your full burden. 30% of which will be taken out by the government. So your cost of capital is just 7%. 10%, get the 30% for the government. Your cost of capital or your burden, because you're using others' funds, is only 7%. Okay? So that's the answer for the first question, although I have discussed it lengthily. This is important. The cost of capital that you have computed for the debt, which is interest, it needs to be after taxed to get your burden, your effective burden as a company. This is not applicable when we talk about equity later on. There is no after tax when it comes to dividends because dividends are not tax deductible. So you could not use the dividends that is being paid by the company or the business so that your taxes will be lower. This is unlike the interest. You can actually deduct the interest so that this will become lower and your taxes will be lower. So again, if we're talking about cost of capital related to debt, you have to after tax it in order to get your real burden. Okay? Because interest is tax deductible. That is not the same with the equity. The equity, the dividends that we're going to talk about later on, is not after tax anymore because it's already after tax. Actually, after you get this net income, after tax, this is where dividends happen. After the net income has been taxed. Actually, the net income after tax will go to the retained earnings account first, and that on the retained earnings that is to be restricted should be separated, and the retained earnings unappropriated will now be available for dividends. So, actually, This dividend story comes after the tax issue. Okay? That's it. On the dividends, it's not after tax anymore because it's already after tax. On the interest, you have to after tax it first because the real burden that you have should be the cost of capital, not the 100%, because a portion of which will be handled by the government. That's it for the first question. Now, next. How important is computing the cost of capital? It is very important, especially if you're getting funds from others and that the funds you're going to use them into investment opportunities. So if there are a lot of investment opportunities to choose from, you should select those investment opportunities that has a return of higher than 7%. Because, again, you got those funds, you have to pay this cost of capital plus the principal. So if you're going to invest the money, make sure that it is 10% or 12% higher than the 7%. So that means cost of capital is very important when considering investments. Okay? So in a company, you should get the weighted average cost of capital of the company. Because if you are in a company, those funds will be invested in business opportunities. Right? So you should invest it at higher the cost of capital so that the company will survive. So that's how important cost of capital is. Okay? Now, when talking about cost of capital, there are a lot of formulas here that you need to memorize. But I have this, what do we call, style that makes me remember everything, which is why I have also to share it to you. Let me check if it's still recording. What is that? First off, I have realized that the cost of capital rate, if you are going to, what do you call this, expound this 10%, it's actually, you have to get the interest, net interest that you are going to pay, which is, in this case, 5 million times 10%, that is 500,000. Net interest when it comes to debt, but net dividends when we are going to talk about equity. So, I'll use first net interest because we're talking about debt. So, net interest, 500,000. And then, over proceeds. That is actually the main formula only of the cost of capital. There are some revisions only, but that is the main formula. And it's very easy to understand. Why is this so? So, actually, 500,000 is the net interest based on this simple illustration and of course divided by 5 million, which is why we got 10%. It's as if, how much will you pay? Interest, 500,000. How much did you get? 5 million. So that means that's 10% out of your proceeds gotten from the loans. I'm so sorry about my pronunciation. As long as you understand, that's okay. So 500,000 divided by 5 million, that's 10%. It's very logical, right? You have the numerator, the net interest, and then the proceeds. Okay? So whenever there are some problems that are a little bit, what do you call this? There are a lot of twists. Like for example, you have loan 5 million, you have 10% interest. However, the interest is based on the 5 million, but the proceeds is actually the principal less advance interest already. Less the advance interest and less 2% service charge, something like that. So, the simple problem, which is this one, of course, there is after-tax rate. We are going to introduce already some complications, like the proceeds is actually principal, less the advance interest, less 2% service charge. And one of the conditions of the bank is that you have to have a compensating balance of, or compensating balance or savings account of 500,000 first before you can loan. And that 500,000 compensating balance uh, will not be withdrawn, but it will earn 5% interest income. Right? And let's go full blast. Um, the company has already a balance of 200,000 which were not withdrawn. Something like that. So, even if this is a whole lot complicated than the simple that we have talked about earlier, which is just loaning 5 million and paying 10% interest, you could still get the cost of capital logically by using that net interest and then the proceeds. Okay? So, again, you loan 5 million. It has 10% interest based on the 5 million. But the proceeds, you're not going to receive any 5 million. So that means you cannot use the effective interest as 10%. Okay? Because if it is really 10% only, the interest is only 10%, then you should have received proceeds of 5 million. But in fact, it is not. You receive principal less the advance interest. So that means 5 million and then you deduct the 500,000 and then there is a 2% service charge pa. And then there is a compensating balance of 500,000. Again, this is a contractual obligation of the company in which you have to put a savings of worth 500,000 and you cannot withdraw it until you paid the whole loan. So that's the compensating balance. And since you cannot withdraw the 500,000, you will earn 5% interest income on that compensating balance. And then, the company has already a balance of 200,000, which meant that you should only add this 200,000 by 300,000 so that you'll be able to follow the contractual obligation of having a compensating balance of 500,000. Okay? And since I've already discussed that, you can use this. Actually, you just put there, what is the interest expense? Because net interest is interest expense less interest income. And you already know why is there an interest income here, especially with our illustrative example. Because the compensating balance will earn 5% interest income. Now, the proceeds is proceeds. The take home, the money that was really handed to you actually by the bank if you are having a loan from a bank. Okay? So let's apply. Like the interest expense is just 10% times 5 million because usually this 10% that is going to be given in the problems and in the bank, this is usually based on the principal that you have loaned. That is not based on the proceeds that you're gonna receive. Okay? So 10% times 5 million, that's 500,000. And then you deduct here the interest income that you are going to earn. Okay? So what is the interest income rate? It's 5%. But it will not be based on the 500,000. It is only to be based on the 300,000. Why 300,000? Because you already have the 200,000 savings before you engage in the loan. So meaning, you just have to add 300,000. So 300,000 times 5%, that is actually the interest income times 5%. And that is actually 300,000 times 10% is 30. So this means this is 15,000. So your net interest is actually 500,000 minus 15,000. You have an effective burden only of 485,000. However, that 485,000, you'll not be happy because you're just going to be happy if ever you have received the full 5 million, but you did not. According to the problem, you have 5 million as principal. However, you deduct the interest immediately, which is the interest to be deducted is 500,000 immediately. And we have 2% service charge. So 5 million, where is my calculator? I could not do this already. So you have 5 million times 0.02 or 2%. You have 100,000 as service charge. Normally, the service charge is being charged to the borrower because of the transaction. Because the bank has given you an opportunity to take a loan, they're gonna have the service charge as if this is their service of loaning you some money. Alright? So 5 million minus 500,000 minus 100,000. Is that it? And minus 300,000. Because normally, you are not going to get money from your personal pockets in order to put the 300,000 in the bank. Normally, the bank usually deducts it from the loan that you have. Since we have 5 million, it is automatically deducted. Okay? So, that's your proceeds. So, 5 million minus 500,000 advance interest minus 100,000 minus 300,000 compensating balance, additional compensating balance, you will have 4.1 million. So your cost of capital is 485,000 divided by 4.1 million. It's actually 11.83%. But then again, that is not your 100% burden. Because if there is a tax rate in a certain company, like for example, it's a certain country, like the tax rate is, let's follow this 30%. So that means your real burden is 11.83%. 11.83 times 0.70 only. That's 8.281%. So that's how you compute your cost of capital. And of course, if this is your cost of capital actually, and you got the proceeds already of 4.1 million, be sure that as a finance manager, you're going to invest it in ventures, in business opportunities, which are having return on investment higher than 8.281%. Okay? So that's how important the cost of capital is. Alright? Now, we're talking about here short-term loans. That means the maturity term is 1 year or less. Sir, what will happen if this is 6 months only? If this is 6 months only, you have to consider the 6 months in the computation of the interest expense and interest income. Okay? So this interest expense might be 500,000 times 6 months over 12, as well as this 300,000 times 5% times 6 months over 12. So the numerator will change. Of course, the proceeds will also change. I don't think, because the interest here of 500,000 will become lower because 500,000 times 6 over 12 will be the what will be deducted here, and you will get a different percentage. But then again, you have to remember that that percentage is only for 6 months. So you have to multiply that again times 12 over 6 so that you are going to get the cost of capital for 1 year. Okay? Because normally the cost of capital is expressed in annual annual rates. Okay? So how about if the maturity term is 5 years, for example, that's more than 1 year. Okay. If that is the case, you have to have a knowledge about interpolation. Okay? You know about interpolation. I will assume that you know already how to get the interpolation. I guess I have to redirect you to a certain video so that we can have an example on how to get the effective interest rate of long-term debts. Okay? So, this is the thumbnail. You have to study this. And if you can already get the effective interest rate using interpolation, for example, let's continue. The effective rate that you have, again, this is the thumbnail for the effective interest rate. And assuming that you have already viewed the video, let's assume that the effective interest rate that you got is 13%. Again, that is not yet the cost of capital. Why? Because you still have to multiply it with the after-tax rate. And in our example, that's 30%. So the after-tax rate is 70. So 100% minus 30%, that's 70. Okay? So 13% times 0.70, that's 9.1%. Okay? So that's it. For the debt, it's just the net interest, which is just interest expense minus interest income over proceeds. So whatever they deduct, like the principal minus the advance interest in the problem, minus the service charges, and minus the compensating balance that you need to put as savings that could not be withdrawn unless you pay the loan. That's proceeds. You get the rate, and you after tax it, that is already the cost of capital, which is a measure that could be used in evaluating business opportunities. Okay? Now let's go to equity. Alright? When it comes to equity, theory first. When it comes to equity, when you choose this, because you need money for your company, and you choose selling of shares, remember that the cost of capital rate for equity is greater. Okay? Why is it so? It is because the investors, for example, let's go to the point of view of the investors. In the investor side, being an owner of a company, a shareholder, is much riskier. Is more risky. I don't know what's the English. It's much more risky than being a creditor. So if you have a lot of money and you wanted less risky investments, you have to give that to borrowers because the borrowers will pay for interest. Regardless of how they invest their money, the borrowers will pay interest at 6 months or quarterly or 1 year. It's not true for the company. If you are going to release your money and buy some shares, it is not guaranteed that you are gonna get some dividends. Because it depends upon if ever the company has retained earnings, the company is doing well, or the company has a net income. Because if the company is losing, it will not pay dividends normally. So it's much more risky. If on the side of the investors, it's much more risky if they buy shares. So they will expect a higher return. Because in here, in the financial management, the higher the risk, the higher the return. Okay? So you have to expect that you have to pay a higher cost of capital rate here on the equity. Okay? So, how do we compute for the cost of capital here, if you are going to get funds from shareholders by issuing some shares. So there are a lot of methods here. But still, you have to remember net dividends or net interest over net proceeds. This is still in play. Okay? So, we have first, the easiest in computing the cost of capital rate. We have the bond yield plus premium. So what is this? It's just copying the cost of capital of the debt because bonds is actually a debt instrument. For example, bonds payable. So what is the effective rate of your bonds payable? You have to copy it. Like 13%, for example, is the ones that you have computed using interpolation on your bonds payable. So you have 13%. But there is a plus premium. For example, in the problem, you're given a 3% premium. So that's already 16%. That's how easy the bond yield plus premium. And again, there is always a plus because the investors are taking more risks by giving you money as an owner rather than a creditor. So normally, the cost of capital rate for equity is higher. Okay? Do we need to after tax this? Again, we don't have to because this is already as if after taxed already. Okay? So that's bond yield plus premium approach. And we have the dividend growth model. On the dividend growth model, you just have to examine the dividends that you have paid for in the past and you put a growth rate. Because again, the shareholders, the providers of funds, are always expecting a higher return rather than the creditors because they're taking on more risks and they wanted those dividends to grow over time. So if you have paid for 5 pesos per share in the past plus the growth rate, like for example, it will become 6 in the future, you have to consider that. However, we're not deriving any percentage. Again, the cost of capital should be in percentage format. So what will happen? For example, you have 5%. Okay? That is your past dividend or future. For example, in the next year, you are expected to give 5%. Okay? 5%. 5 pesos per share. You divide that with market price of the share minus flotation cost. That's how you get the percentage plus the growth rate. Like for example, the growth rate is about 5%. So the market price of the share, again, the market price of the share is, what if you wanted to be a shareholder? So you have to pay for the market price of the share. And the more established the company is, the more popular, the more profitable, the more trustworthy the company that you are going to buy shares from, the higher the market price. Okay? So for example, the market price is about 15 pesos or 20. What is this flotation cost? So, it's as if this is just proceeds. Okay? When you sell your shares, you're gonna get 20 pesos, the market price. Somewhat like the proceeds in our debt a while ago. Alright? So it's as if this is the principal, and flotation cost is as if the interest, the service charges, and those that are to be deducted. Normally, the flotation cost is, for example, a selling cost. So when you decide to sell your shares, you're gonna get 20. However, you have to pay, for example, 3 per share to the brokers, to the stock brokers. So that means you have 5 over 17. So you're gonna get first the interest for that one. 5 divided by 17, it's 29.41 plus the growth rate of 5%. Again, 5 divided by 17, that's 29.41 plus 0.05. Oh no, times 5 divided by 7, no. 5 divided by 17 plus 0.05, you're gonna have a cost of capital of 34.41%. That's dividend growth model. Okay? So as the company, it's as if like this. What is your cost of capital? Dividends. So how much is the dividend that you are to pay in the future, in the next year, for example? 5 per share. How much is the proceeds that you have gotten when you sold the share? That's 20. How much is the flotation cost, like the selling cost, the stockbroker's cost? Is 3. So what will you do is that the 5 per share that you have to pay minus the benefit or the proceeds that you have gotten per share, 20, minus the flotation cost, 17, and you're gonna get the percentage. Plus the growth rate, that is already the cost of capital under dividend growth model. Okay? It's very logical. It's very the same with this one. However, we're using dividends. And then instead of net proceeds, let's still use this as net proceeds per share. Okay? This is net proceeds per share because you're gonna sell it at 20 minus the selling cost of 3. This is the net proceeds per share if you're going to sell it. Okay? Now, 2 reminders. First reminder, you can have this in the form of not per share, like total dividends. You're given in the problem, the total dividends is 5 million because there are 1 million shares. 5 million. You can have the numerator as 5 million. But you also have to divide it with the denominator, which is not per share also. It should be the net proceeds as a whole. On the 1 million shares, what is the net proceeds? So, for example, that's 20 million. So you have 5 million over 20 million. That's okay. Okay? So this is a per share analysis. You can do this also. But you can also have the total dividends and the total market price or the total net proceeds on the dividends. You're going to get the same percentage plus the growth rate. Okay? So again, that's dividend growth model. Second, this is the last one that you need to remember. Make sure that this 5 pesos is not the ones being paid before. It should be 5 pesos to be paid after 1 year. So it has not yet been paid. Okay? Because if it is already paid before, like for example, 5 pesos has been paid 2 years ago. That means you're not going to use the 5 only. You have to use 5 times 1.05 with the growth rate already. You have to use the numerator at 5.25. And that is separate from the growth rate still. Okay? So you have to make sure that this numerator, the 5 pesos, is to be paid still in the future. Otherwise, if it is already paid in the past, you have to gross it up. You have to add the growth rate. Okay? And I guess this is what I like, the dividend growth model, among all the methods in computing the cost of capital for equity. Because it's very logical. It's just like this. Net interest and net proceeds. Okay? Now, let's have the other one. We have the CAPM approach. Capital Asset Pricing Model. On the capital asset pricing model, what you're gonna use in order to get the cost of capital is risk-free rate plus premium but this premium times beta. There is a beta. CAPM rate. What is this? First off, if we're going to put numbers, we have 10%. The risk premium, for example, is the market rate, which is 15%. For example, the market rate is 15%. This is just given, this 10% and the 15% minus risk-free rate. So the premium is actually 5%. And this 5%, before you add it with the 10%, you have to multiply it first with the beta. For example, the beta is 1.25. So the answer will be 1.25 times 5. You have 6.25. So 10% plus 6.25 percent, you have 16.25%. That is already the CAPM rate. So mathematically, it's just like that. Risk-free rate plus risk premium. And then the risk premium is just the market rate minus the risk-free rate. And then you have to multiply first the risk premium with the beta. And then you're gonna get the answer. And you have to add it on the risk-free rate. You have 16.25. Mathematically, that is very easy. But you have to know the concepts behind this. Let's first start with the risk-free rate. The risk-free rate is normally, when I was studying, I was always thinking of this rate as the lowest rates given by the government. Okay? So meaning, if you get funds from the government, you have to pay lower rates, which is true. It is because, on the side of the investors, if they're going to invest in the government, they're already assuming that there is little return in the government. It's because there is no risk in the government because government is the most stable corporations or organizations in the world. Okay, they are not easily bankrupt. So again, the investors of money to the government are already expecting a lower return. So in effect, there will be a lower rate that will be charged to you if you are going to borrow from the government. So that is what I call as risk-free rate. Okay? So, how about this market rate? This market rate is actually the rate when you borrow in private companies in the market. For example, when you borrow from a privatized bank, like Petrobank, China Bank, something like that, that is the rate, the normal rate, 15%. Government rate, normal rate in the private. So there is a risk premium of 5%. What is that risk premium? The investors investing in private banks, for example, are expecting higher return. Why? Because they are not as stable as the government. And since they are assuming higher risk, they wanted high returns. And it will also translate here in the market rate. Okay? So how about the beta, sir? What is the meaning of the beta? The market rate is fluctuating always. Alright? Sometimes it's 15% and then tomorrow it will become 13% and then 12% or something like that. And then 14 and then 15, something like that. So in order to describe the volatility of the market rate, there is beta. And I guess if the beta is 1, that means the market rate is stable. Okay? The market rate is stable. That's the theory that I know. Alright? So if I'm wrong, you can comment it in the comment section below. But in order for me to understand this when I was in college, I usually think of the risk-free rate as the government rate, in which when you borrow from the government, you are going to pay lesser interest rate because the investors of the government are actually expecting lower return from them because they are stable and less risky. Okay? How about the market rate? It's the market rate in the private banks. So this premium is easy, market rate minus risk-free rate. And the beta is just a descriptor of how volatile the market rate is. So the premium is also volatile if the beta is higher. Okay? So that's for CAPM. Okay? So that's actually the last, but there is what do we call as, what if on the third option, I'm not going to have a debt or I'm not going to get funds from shareholders? What if I'm gonna use my own retained earnings? Of course, you already know this. The retained earnings are the net income of the corporations. Every year, they are going to be put here in the retained earnings. Some will be restricted, some will be given as dividends. But for example, if all of the retained earnings, for example, are retained for expansion of business, something like that, if you're gonna use these retained earnings, you just have to copy the rate here on the equity. But you will not include any flotation cost. What does it mean? For example, if we're talking about using retained earnings, and then you have already computed the equity using dividend growth model, and we have 34.41%. What you're gonna do is that you get the dividend, which is 5, over 20. You should not include any flotation cost because there is no flotation cost when you use your own funds, right? It's very logical. Flotation cost is actually when you sell your shares and then you have to pay for commission for stockbrokers. That will not happen. You are not going to pay any broker's commission when you use your own funds. So instead of this 20 minus 3, you only use 20 and then you add the growth rate. That's what will happen. You just ignore the flotation cost. And if that's the case, you'll have 5 divided by 20 plus 5%. 5 divided by 20 is 25%, plus 5%. You have 30%. And that's it. Okay? So it's much less costly than this one because you are paying flotation costs. Okay? Now, last. Actually, in businesses, there is what do you call this? The company is not limited to having one source of capital only. Which is why sometimes, if the company is in need of 100 million, that 100 million can be financed by long-term debt, for example, of long-term debt number 1. The weighted average cost of capital is 7% based on your computation as if. And then you got a proceeds of 15 million here. Proceeds, that means principal minus service charges and other flotation costs already. Flotation cost, this is the spelling. So that's 15 million, that's 7%. Is that very important? Yes, this is very important because this will become the weight. You have to compute 15 million times 0.07. We have 1015. And then you have another long-term debt. You got 19 million, but you have to pay 10%. So, 19 million times 10%, that's 1.9 million. But before we go to that, I forgot that when you talk about equity, what we have talked about the bond yield plus premium plus model, dividend growth model as well as the capital asset pricing model and the retained earnings. Sometimes you are going to use preference shares. Okay? These are all, this bond yield plus premium plus dividend growth model and this capital asset pricing model are usually the methods when computing for cost of capital for ordinary shares. Alright? But when we talk about preference shares, it's just like this. You get the dividends to be paid for the preference shareholders. Normally, preference shares has a percentage, and usually that is multiplied against their par value. For example, 10% times 10 million is the par value. You have dividends of 1 million. And then you get the market price of the dividend, market price of the preference shares minus flotation cost. That's it. I just wanted to mention that you could also get funds by issuing preference shares, not only ordinary shares. I forgot that one. Okay? However, the good thing about preference shares, since it has a percentage already, that is already fixed. So there is no growth rate involved. Unlike the ordinary shares, because the ordinary shares actually are the ones who will get the net income residual, the residue already. That means the ordinary shareholders are the ones exposed to so much risk. Okay? So, in the point of view of the investor, actually, before we go to this one, if you have a lot of money and you wanted what do we call this? You wanted to know which is the least risky to the most risky. You'll start with the least risky. You become a creditor. You give your money to borrowers. Short term or long term? The least risky is short term, of course. But when you do that, you expect a lower return because you have the lowest risk. Okay? Next on the hierarchy is the long-term debt. So if you are going to give your money to those borrowers under long-term debt agreement, you will charge more interest because the higher the risk, the higher the return should be. Alright? And after the debt, if your option is getting money or after the debt, if you wanted, again, we're on the point of view of the investor, if you wanted a more risky than the debt, then you issue shares. You buy shares. Okay? When you buy shares, which shares are the least risky? Of course, the preference shares. The preference shares has a fixed rate, unlike the ordinary shares. They have no fixed rate. They're not to be given first also with the net income. So, this is the least risky on the shares. Okay? After that, you have the ordinary shares. And we have the option of using your own funds also. Okay? But in real life, you get money first from your friends. That's the lowest cost of capital. Sometimes they're not going to charge anything. Okay? So actually, your knowledge in here could also be used in your personal finance. So you have to find sources of funds with the lowest interest rates. And you can use everything that we learned here when computing for um, cost of capitals from different sources of funds. Okay? Now, again, let's go back. If you are a company and you are in need of 100 million, sometimes you cannot get that 100 million from one source alone. So in our example, we have long-term debt 1, long-term debt 2. You have 7% here. We have 10% in the long-term debt 2. And you have your preference shares. You have issued preference shares to get money, and you got 25 million. But you are to pay 15%, something like that. So you have 25 million times 0.15. You have 3,750. And you have ordinary shares. Let me check. You have 15 plus 19 plus 25. You have 59 already. For example, on the ordinary shares, you have 30 million. You got 30 million. So, on the ordinary shares, of course, that is 20%. That is the cost of capital. So, as if you have already computed that with with a certain specific method here, like dividend growth model. I like this one. So that's 20%. So 30 million times 0.20, and you're gonna have 6 million. So you have retained earnings already for the 29 million. Let's see if that is already 100 million. 15 plus 19 plus 25 plus 30 plus 29. 118. So 29 minus 18. So that's 11 million. 15 plus 19 plus 25 million plus 30 plus 11. You have 100 million. This is about 19%. So 11 million times 0.19. You'll have 2,090,000. So if you wanted to get the WACC, or weighted average cost of capital, you have to add this. So 1,050,000 plus 1 plus 3,750,000 plus 6 million plus 2,090,000. We have 14,790. 14,790 divided by 100 million. That's 14.79%. So, if that is 14.79%, the 100 million proceeds that you got from different sources of funds, you should invest it in a business opportunity that gives more than 14.79%. Otherwise, your company will fall because you have to pay this. So for example, if there is a business opportunity for 100 million which will pay you return on investment of 25%, that's okay. But if there is a business opportunity that gives 10% return on interest, return on investment, you have to get away from that um, opportunity because it will bring you losses. So that's how important computing the weighted average cost of capital. Okay? So it's very logical. So again, the cost of capital is the cost of using others' funds. So if you are going to get funds from debt, how to get the cost of capital rate? First, you get first the net interest. So the net interest is just the interest expense that you have to pay minus the interest income if ever you're going to have an interest income because of a compensating balance requirement from the creditor over proceeds. That means principal minus advance interest minus service charges and minus anything any other else which are called flotation costs, so that you're gonna get the proceeds, which will become the denominator. The proceeds are the take-home money that is actually given to you by the creditor. Okay? And after you get that, You multiply it with the after-tax rate because 100% of the interest is not really your burden. Some of it are burden of the government. So let them take the partial burden and you get the after-tax rate only. Okay? And that's the cost of capital for short-term debt. When we talk about long-term debt, you have to have interpolation. So again, you visit the interpolation video so that you will know. And then you get the effective interest rate. And the effective interest rate is not yet the cost of capital. You have to after tax it first. Okay? So that's for the long-term debt. And when we talk about issuing of preference shares to get funds, so of course, your cost of capital is in the form of dividends. So you get the dividends. It could be dividend per share or the total dividends. Dividend per share or dividends is the numerator over the market price or the proceeds. Market price of the shares if you're going to sell them. Okay? And then minus the flotation costs or the costs necessary to sell your shares, like um, brokerage fees or stockbrokers commissions, something like that. Those are flotation costs. And you will have the cost of capital for preference shares, cost of capital rate. No need to after tax it because it's already after tax. Okay? And then when we talk about ordinary shares, when you issue ordinary shares, you have methods. You have the bond yield plus premium, which is just the copying of the effective rate. The effective rate from the debt, and then you just have to add premium because again, it's much riskier for investors to invest in shares, in your shares, which is why you have to pay a premium. Okay? And we have the dividend growth model, which is still dividends. It could be dividend per share or the total dividends divided by the market price per share or the market price in total minus the flotation cost per share or the flotation cost in total plus the growth rate. And you have to remember that this dividend should have not been paid first in the past because if it is paid already in the past, you have to multiply it with 100% plus growth rate already. That should be the numerator. Okay? It's already grossed up. It should be grossed up if this dividend has already been paid. Divided by, again, market price minus proceeds plus growth rate. The growth rate is separate from that grossed up still. Okay? And we have the CAPM approach in which that is just the risk-free rate or the rate, again, related to the government, and then plus the premium, which is the market rate, minus the risk-free rate, and you multiply it with the beta, and then after getting the risk premium multiplied with the beta, you add it with the risk-free rate, and you're gonna get the CAPM cost of capital. And lastly, you could actually use your own funds, your own retained earnings. You just have to copy your whatever you did in getting the cost of capital rate on your ordinary shares. However, you disregard the flotation costs because you are not actually paying for flotation cost if ever you use your own funds. Okay? And of course, in getting the weighted average cost of capital, you get the proceeds and the cost of capital rates. You multiply them because this should be the weights. Because sometimes, although this is a lower rate, for example, but this is only 1 million, it will not have a real effect on the weighted average cost of capital. This should be weights. Okay? And after doing that, multiplying the proceeds times the rates, you're gonna get the total dividend and interest, total cost of capital divided by the total proceeds. That is your weighted average cost of capital. And that will become your basis as one of the criteria in selecting business opportunities. Okay? So, that's it for the cost of capital. Again, one of the finance managers' responsibility is to get funds from sources with the lowest cost of capital. And of course, you can only do that if you know how to compute for the cost of capital. So if you learned, please click like, subscribe, and hit the notification bell and share this video to those who need them. Thank you.